I'm going to answer two questions in this video. First, what is an ETF? And second, why should you care? And by the end of this video, if I've done my job correctly, you will have enough information to impress your friends with your newfound knowledge about ETFs. So let me start off with a very simple definition. An ETF stands for Exchange Traded Fund, and it is a type of investment that contains a bunch of different securities that trades on the stock market as a single unit. So think of it like a basket that holds a bunch of different stocks or bonds or other assets, and you buy shares of the basket. The price of each share represents your portion of ownership in all of the assets contained within that basket. For example, let us say you have a basket that has 4 apples and 4 oranges, and you cut up the basket into 10 slices. Then each slice represents a 40% apple and 40% orange. If someone were to come along and buy 3 of those slices, they would own 120% worth of apples and 120% worth of oranges. That means they actually own more apples and more oranges than the entire basket itself. Now, if one of those apples were to fall out of the basket, each of those slices now represents a 30% apple and a 60% orange. And the person who bought 3 of those slices now owns 90% apples and 180% oranges. This means they actually own more oranges than the basket itself. Now, don't worry, because this is not a math lesson, and we're really not going to do any more complicated calculations than that. But hopefully that illustration gives you a better idea of how ETFs are similar to mutual funds in that they both contain a collection of different securities, and both can be bought and sold throughout the trading day. But there are some important differences between them. For instance, unlike mutual funds, ETFs are actually bought and sold on exchanges, hence the word exchange traded in ETF. In fact, they read just like any other security that you buy and sell on exchanges, like individual stocks or bonds. You can buy or sell ETFs through your brokerage account on trading platforms. In addition, ETFs are usually much cheaper to own than mutual funds. Many ETFs charge an annual management fee of less than 0.1%, while many mutual funds charge over 1%. Now, there are many different types of ETFs, and the list keeps growing every year. There are ETFs that track broad market indexes like the S&P 500 or Dow Jones Industrial Average. These are referred to as index ETFs. Then there are ETFs that focus on a particular sector of the economy like technology or healthcare. For example, the Technology Select Sector Spider Fund tracks the performance of the tech sector. There are even ETFs that invest in specific investment strategies like the PowerShares QQQ Trust, which invests in companies with strong momentum. And I just mentioned Broad Market Index, ETFs, and Sector ETFs. Those are the most common ones that retail investors like you and I buy. But did you know there are also currency commodity ETFs, bond ETFs, volatility ETFs, and international ETFs? Wow! That's a lot of options. Don't worry, because you don't need to buy every single type of ETF out there. In fact, broad market index ETFs are the ones that most investors should own, because they tend to outperform actively managed mutual funds. A study conducted by the fund company S&P found that over a 15-year period from 1995 to 2010, the average actively managed U.S. stock fund only beat the S&P 500 27% of the time. The reason for this is because many actively managed funds have high turnover rates, meaning they buy and sell a lot of stocks throughout the year trying to beat the market, and in the process they incur capital gains distributions, and they also pay a lot in taxes. This hurts the investor because they often have to pay taxes on those capital gains distributions. Even if they didn't sell anything, the broad market index ETFs, on the other hand, don't try to beat the market, they simply track it. Therefore, they have much lower turnover rates, which leads to fewer capital gains distributions and ultimately fewer taxes paid by the investor. Plus, when you consider the fees that the funds charge, broadly diversified index ETFs are usually the cheapest option for most investors. But wait, what if you could get all the benefits of ETFs that I talked about a minute ago, plus high yields, like what you get from a real estate investment trust or REIT, and a closed-end fund? Closed-end funds are quite unique. They have a fixed number of shares that are issued at the time of its creation, and then those shares are bought and sold on the secondary market, aka The stock market. Unlike ETFs, their share price doesn't track the value of the underlying assets. Instead, it's determined by supply and demand on the open market. An example. Let's say there's only 100 shares of a closed-end fund that invests in shopping malls. If only 50 of those shares were trading on the open market, then the price of those shares would likely be higher than their net asset value, or NAV, which is the actual value of the shopping mall real estate. Conversely, if 150 shares of that same fund were trading on the open market, then the price of those shares would likely drop below their NAV. Now here's where things get interesting. When a closed-end fund trades above its NAV, it creates a capital gain. Let us go back to that shopping mall example and pretend that the NAV of the fund is $10 per share, but the current price of those shares on the open market is $12.50. That means that any investor who buys those shares for $12.50 per share, and then the fund's NAV increased to $11 per share, that investor would experience a capital gain of $1.50 per share. On the other hand, if the fund's NAV dropped to $9.50 per share, then that same investor would experience a capital loss of $3 per share. The good news is that many closed-end funds pay high dividends, especially those that invest in real estate. For example, a closed-end fund that invests in residential mortgage-backed securities pays a whopping 12.7% dividend yield. However, the bad news is that a significant portion of that dividend comes from return of capital, which is a fancy way of saying the fund is returning your own money back to you. In fact, EQR has been returning more money to shareholders via return of capital than the interest that it earns on its investments. As a result, savvy investors recognize that buying EQR is really just like buying a bond with a very long maturity date that pays you a higher interest rate in the form of dividends, instead of return of capital. Okay, so far we've learned what an ETF is and why you should care. But I promised to answer 2 questions in this video, and the second question was, why should you care? Well, the truth is, ETFs have changed the investing landscape forever. First, they're cheaper than mutual funds. Second, they're more tax efficient than mutual funds. Third, they offer investors more diversification opportunities without having to manage a bunch of individual stocks. Fourth, they're a lot more flexible than mutual funds. Since ETFs trade on exchanges like individual stocks, they can be bought and sold throughout the trading day, whereas mutual funds are only priced once per day after the markets close. Finally, ETFs provide investors with a level of transparency that's hard to match. Since ETFs trade on exchanges, their prices are updated throughout the day, whereas mutual funds are only priced once per day after the markets close. In addition, the holdings of an ETF must be disclosed daily, whereas many mutual funds only disclose their holdings on a quarterly basis. But don't be fooled, because ETFs aren't perfect. They can be more volatile than mutual funds, especially those that focus on a particular sector or investment strategy. This is because they have a narrower focus, which makes them more susceptible to changes in the overall market. In addition, although ETFs are generally very liquid, some of them can be illiquid, especially those that focus on a particular niche. This can make them difficult to sell if you need to raise cash quickly. And finally, because ETFs trade on exchanges, they're subject to trading volume and market maker issues, which can cause their prices to temporarily deviate from their NAV. Now, even though ETFs are great, you still need to do your homework before investing. Just because an ETF is popular or has a low expense ratio doesn't mean it's right for you. It is important to understand the risks involved in investing in any type of ETF before you put your money into it. For example, if you want to invest in real estate without actually buying physical property, then a real estate ETF may be right for you. But if you're looking for a more diversified portfolio of stocks and bonds, then a target date fund may be a better option. Thank you for watching. Please like the video if you enjoyed it, and subscribe if you haven't already. And let me know in the comments section below if you'd like me to do more videos on ETFs in the future. Until next time, take care.